All right, what's going on, everybody? This is your primer here on selling options. Okay, we're just going to do a little bit of insight here that'll help you guys just kind of get started and basically just push yourselves in the right directions. I'm sure, and let's do it just a quick poll here. Like, obviously, some of you guys that are long options predominantly, okay, go ahead and give me a percentage, like percentage from trading long options versus percentage from trading short options. Okay, so what are you, 80-20? Are you 90% long options? Are you 50-50? You know, what's the story here? Okay, we got a lot of 100% longs here. We got some 80-20s. 50-50. Yeah, short needs more capital. We'll talk about margin here too as well. Faye is saying we're broke. Patrick, we got a couple of people that have never traded options. Okay, all right, so let me give you a little story, right? I used to be 80% options. I used to be, 80% long options. Actually, I used to be 95% long options, okay? Guess what I am now? I'm 80% short options and 20% long options, okay? And let me give you an idea as to why, right? You take a look at a name like a Goldman Sachs, right? Like, I've been looking at this thing for, you know, months, all right? And again, I look at the same stocks over and over, right? So I'm not out there aggressively looking at that many different names to trade, okay? Now, for the Goldman, all right, you can see that for 6 months, this thing pretty much did nothing, okay? Now, for most of you guys who are long options, what are you doing? Let's say you only trade a couple basket of names. What are you doing during times like this, you know? Let's say a stock is really doing nothing, right? And maybe it's just sitting in a range, right? You might be trading the range, okay? But it's not the easiest thing here to trade that sort of range. So what are most people doing during times like this? Okay, most people who are long options only, what are they looking for, right? They're looking for the breakout, you know, or they're looking for the breakdown, all right? And what tends to happen during consolidation, right? Everybody's looking for the same thing. Everybody is looking for the same thing. So it's important for market makers, for, you know, those that are selling that premium out there to push the boundaries, okay? So these are called the fake outs. These are called fake outs, and they happen all the time. They happen within, you know, many different time frames. How many of you guys have been faked out, okay? And what does fake out mean? Fake out means that it looks good, everything sets up right, you go long your call, you go long your put option, and you know you think you're right because it broke down technical levels, whatever the hell it is. All right, and then all of a sudden, it shoots back sort of in the other direction. How many of you guys have been in that sort of scenario? And frankly, if you all don't say yes right now, you know, you're talking shit, right? So this is what happens to most traders all the time, right? They'll start buying calls aggressively up here. Now, not that there's anything wrong with that. There's nothing wrong with that. What's wrong is that not understanding when things are fake outs and when things are actually real. You know, a lot of it takes a lot of plugging around. Now, during this time, though, this is a great time to sell premium because all these moves to the upside, generally speaking here, just get knocked back down. So you can sell that nice juicy call premium up here from people that, again, are basically like yourselves, paying too high for an option that is not supported. And 80% of the time, guys, what happens, right? You don't get that breakout. You don't get that breakout. And the money goes to the market makers. Okay, so think about this just logically, right? If you're 100% long, okay, like some of you guys here, we got Brad Cooper here, we got a couple other guys here who are all 100% long, okay? If you're 100% long and only 20% right on the breakouts and breakdowns, what does that mean for your what does that mean for your necessary win rate and how much you should be pulling in for a solid move? Okay, I mean you could sit there and do the math yourself, right? I mean if you're 100% long, okay, and you're only going to be right on a breakout or a breakdown 20% of the time, All right, that means that you're going to be wrong 80% of the time right here. You're going to be taking losses 80% of the time right here. And guess what? If you're not aggressively in this and you don't make all that money back and then some, then guess what? Generally speaking here, you don't really have a winning strategy. You're not really going to survive here, okay? Now, some of you guys might be day trading, whatever the hell it is, but you understand my point here. Okay, now I'm not saying you should immediately switch to some short option stuff. I'm just saying look at it from the number perspective and look at it from your skill level too. If you're not quick enough to take profits on a freaking day trade over and over and over again, what chances do you have? Similar to swing trading and going long options. Okay, if you're only going to be right, you know, 40% of the time, and you're 100% freaking long, are you ready to take all those losses? And are you confident enough that when you get this move, you're going to be in it, make all your money back, and then add some premium on top? Are you confident enough in your skills to be able to do that? A lot of you guys are not at that level, okay? And it takes a while to get to that level, all right? And this is why you want to come in and write some options, okay? Because number one, it can suck up some of your losses that you're taking on your long positions while you're trying to figure out where the hell the stock is going to go, okay? And then number two, it can even clue you in to when a move is actually real, you know? Because all of a sudden, the calls that you've written, let's say on a move that is about to break out, all of a sudden the calls that you've written, you're going to get stopped out of these things. You're going to get stopped out of these things. They're going to look aggressive. You're going to be looking at that option and be like, hold it, wow. So, you know, these people are really buying this, and these options are trading a lot differently. Okay? So it's kind of an instinct thing. It adds to your instinct when you are writing the options. And again, most of the time, stocks go freaking nowhere during these sort of low volatile periods where we just kind of have this meltdown, okay? I'm going to give you guys a freaking layup right now, all right? You guys ready for this shit? I'm just going to give you a fucking layup. You're going to take this trade, and you are going to make money by the end of the week, all right? So shut up and just make the fucking trade, and then you'll start to see what I'm talking about. Okay, the easiest way, all right, to really aggressively write options, and this is where you want to get. This is where you want to get aggressive, and you want to get heavy, and you really want to put the risk out, is when you actually have some breakouts. Okay. Now the beauty of writing options is that you don't essentially have to time this shit, right? I mean, even though Baidu has already moved up 10 points or 12 points. By the way, like this thing is all-time high territory. Everybody wants this thing. Everybody wants the Baba and all this kind of shit. Okay. Now, for a move like this, look at this weekly chain here, okay? What's the likelihood here this thing tanks 10 points here by Friday? Remember, it's Tuesday today. You got 3 days left here till expiration, okay? Now, let's say tomorrow, right, you get a little pullback, maybe, I don't know, to like 259 or something, right? I mean, this thing is up, what, 10 points today, okay? So obviously, you know, you might get a little bit of a dip, all right? And this option could get high as about maybe 25 cents, maybe 30 cents, all right? You guys are gonna come in here and you're going to write this option, okay? You're gonna write, all of you guys write this option here, all right? Write it for one contract, all right? Just write a fucking one line, whatever the hell it is, all right? Write a one line. If you wanna go even safer, right, go to the 245, all right? You can even go further than that. Okay, so let's go to this one, right? So wait for this thing to get to maybe 15 cents or to get to maybe, I don't know, 17 cents or something like that, and just sit on an offer and write the shit out of it, all right? You can do this 247.5 put right here, okay? Now, okay, we're getting comments here that you guys can't hear anything. Everybody still good? Audio still good? Quick mic check here. Yes, no, maybe? Okay, audio's fine. Let's see, Jose here, you know, maybe you need to do something with yourself. Okay, all right. Anyways, okay, so what are we talking about here when you're shorting this put? Why do we want to do this, all right? So for some of you newer guys here, what are we doing here when we short, let's say, this 250 put for a quarter, okay? And remember, this is a freebie trade, so you're going to literally short this with a little bit of a spread. We'll talk about how to make a spread in a second here, okay? But what are we doing? What are we doing? What is the intention here, okay? So Robert is saying, so you're writing out of the money puts for a quarter. Exactly. Okay, But we're going to write this for a quarter, and we're going to make a quarter per contract, okay, that we write, all right? And again, this is a complete freebie. You are, you're going to make 25 cents or whatever the hell it is per contract that you go ahead and write, okay? And now let me go ahead and show you how you would go ahead and put on this trade at your brokerage here, okay? If I could get this stupid thing to work. Okay, so let's say you sell 10 contracts, all right, at a quarter, okay? And this is of the, let's see, 250 weekly put, okay? Now, you're going to buy 10 contracts, all right, and let's say at a nickel, all right, of the 245 weekly put. Okay, now, so every single spread, okay, every spread you sell, you will make 20 bucks. Okay, so if we got a 10 lot here, all right, times 20, we know our max profit is going to be what? 200 bucks. Okay, now when you look at this chain here, all of this premium here is going to evaporate, all right, just like it did in Goldman and just like it did elsewhere, all right. So it's literally a freebie trade for you, all right. Now earnings coming up pretty quick. Look at next week's options, okay. Look at next week's and go to 245, all right. Now that we know the market looks good, now that we know Baidu has broken out into all-time territory, all right. What can we do over here with these next week's options? Look at how low risk we're talking about here. Look at this shit. You can get a quarter for the 240 put. That's 20 points out of the money for next week. And if you get, let's say, a 2-point pullback or a 3-point pullback or something, you might even be able to get 40 cents for this option. You might even be able to get 35 cents for this option. All right. You start to see what I'm talking about here. All right. And again, I'm literally just giving you a layup right here, all right? You're going to pull all this premium down to absolutely nothing, all right? And all you're going to do is sit there and wait for a little bit of a pullback here so you can get in on these options, okay? Just write one contract, all right? Just write a couple contracts. Just get the feel of being in that type of position. Now, what are the benefits? The benefits are you don't have to time shit, right? Baidu has already moved. How many of you guys actually caught this move? Let's ask that question, okay? How many of you guys actually caught this move from 245 to 262? Now, I'm popping around LA and freaking Vegas right now. I didn't catch shit, right? I didn't catch a damn thing, okay? But I have if I'm sitting there watching? Sure. But how many moves do you guys miss on a daily basis? Come on, let's be real. You guys move, you guys lose, or sort of the FOMO situation, or whatever, it happens to you every single day. You're gonna lose out on money every single day on potential. Okay? Just because you have the potential though, it doesn't mean jack shit. Right? After a move like this has happened though, okay? After a move like this has happened, guess what? There's still opportunity. Okay? Again, you guys usually when you miss these moves, how many of you guys are pissed at yourself for missing the move, right? And then subsequently make some shitty decisions chasing another move higher, right? When in reality, the easy money is already done, okay? The easy money is completely done, okay? So you can't get any more of that upside, all right? So there's a lot of folks saying, too, the risk is too much, okay? So let's talk about risk, all right? And this is, again, why, small money doesn't do this, and all the market makers are able to do this. Think about making a market, right? You have tons of orders out there, all right? Your risk to your broker, to your clearing firm, is millions of dollars of risk. Now, you don't expect for any of these things to get filled, okay? Any of these bids or offers to get filled. Right? Most of the time, you're just sitting out there making a freaking market and then, trying to hedge out of a position or whatever it is. So the max risk here, okay, let's talk about this. And this is where, when you guys take a look at it, you're going to be like, well, this is kind of crazy. It doesn't really make sense, right? So you got 5 points of a spread and 10 contracts, okay? So all you're going to do here, okay, is take your $5 and multiply it by your 10 bucks, okay? So that's max risk of $5,000, okay, to make $200, which sounds absolutely ridiculous, right? So your broker is going to look at it and be like, you're you're going to need 5,000 cash in your account or margin to be able to just make $200. So now you're sitting there thinking, well, why the hell does anybody do this, right? Why does anybody do this? Okay. Number one, you're not going to hold out until your max risk. Okay. So your stop here, all right, is going to be 100% of your credit spread. Okay. So let's say credit spread is 20 cents. All right. Your stop loss is going to be at double, all right? Or you might put it at 150%, okay? So your stop loss you're going to put at 40 cents, all right? And then it'll go market, or then, you know, maybe you'll limit it out or whatever the hell it is, okay? So your max loss here, all right, also is, all right, $200, okay? Well, it's actually the 4, right? Okay, so that's your max loss situation right there, all right? And that's how you cap some of this risk that you're taking, all right? But from the broker perspective, this is how much risk is actually on the table, all right? And there are things that could go wrong on gap downs and things like that. But 90% of the time, guys, you're gonna take this $200 to the bank, okay? You guys get that? Everybody get that? Everybody get that example? Okay, you're gonna take this premium to the bank 90% of the time. All right, and again, I can show plenty of examples here. Tomer, sure, $400, $200, whatever the hell it is. All right, but anyways, your max loss here is capped, provided you are putting your stops out. Okay, now you don't want this credit spread to go to a freaking dollar. If it goes to $1, you're wrong. Okay, you're just wrong. That's why you want to be out, get out of it, reassess. Okay, but moves like this Baidu, this is a layup here. This is a layup for free money, all right? And that's how I look at it, right? I mean, I can go to next week and be 22 points out of the money, extremely low risk, and take, what, 30, 40 cents per contract, right? I'd write 100 of these things. Because, again, all I'm doing is just adding some free money here to my book, okay? So again, quick freebie trade here. The primer here on selling options. Okay, number one, you gotta have some margin. Okay, so typically the best accounts to be able to do this, you know, you want to have 25,000. You want to have 25,000 and up. You know, you can do it. You can do it with 5,000, 10,000, but you're just gonna have to really tighten up and sell, you know, just 1 or 2 contracts or 2 spreads. And it's going to be a lot slower, okay? Things are going to be a lot slower, but this is a much more consistent approach. Great. Why? Because you were taking timing out of the equation, okay? And also, guess what? You are taking advantage of time decay, all right? So time decay is always on your side. This is the biggest problem with long options and anybody who trades long calls and long puts, okay? So if you guys have really no idea about options, guess what? This expiration date is a ticking time bomb for your option. And if you don't time your move right, your option ain't going to be worth more than what you paid for it, and you're slowly going to bleed out on that option, okay? And lose that premium. When you become a writer of these options, guess what? Time decay is on your side, and as each day goes by, for example, on this Baidu, as each day goes by, your option is going to be worth less and less and less, which is exactly what you're looking for. Okay, so we're kind of taking 2 things out of the equation: the need for time, okay, when you go, the need for the timing of the move when you go for a long option, okay, and the detrimental sort of aspect of time decay. All right, so you're taking those 2 out of the equation here when you are writing options. By the way, those 2 things are also the same reason why most people who try to trade options fail miserably, because they don't understand those 2 concepts and they can't put it all together. Okay, so that is your quick little primer here on writing options. I advise every single one of you who has a margin account with at least 5,000 bucks, you're going to come to this chain right here, even if it's for a couple of pennies or whatever the hell it is. Okay, try the 250. I would say try the 250. Wait for this Baidu to pull back tomorrow, maybe a couple of points, whatever the hell it is, and you're going to come in here and limit maybe at around a quarter or somewhere around there. You're going to write this 250, or you can come out to next week, you know, and get some fair premiums here and go farther out if you want something less risky, okay? Now, the downsides here is what? You have all that margin tied up, obviously, and you can't really do much else, okay? But again, it's a strategy here that you're going to commit to for the consistency if you guys are having problems going long options, okay? I have now merged the two so that, again, I'm really just scraping up premium most of the time. And then when I see something fat and juicy, you know, and when I see something with some flow on it too from the steam room, you know, for example, like the Netflix here, you know, like the Netflix recently, or the Goldman Sachs recently, or some of the bank moves here that happened, the Baba here that just happened today, the Biden that just happened today. When I see that fat premium come in and people start tagging, you know, options here for it, maybe they're starting to pay for SPY calls, so I know like another move, you know, to the upside is coming. Maybe they're going to oils. Maybe they're going to go back into banks or whatever. And I start seeing some fat premium here, then I'll start going long calls. Then I'll start laying out some risk on the long calls when I really like that move. Okay, and I've been planning for it and I've been waiting for it. But most of the time, I'm just sitting here just shorting shit. Just give me that easy premium. Let me make my 5-10 grand every single week. And then if I got a Goldman Sachs on my hand, okay, I'm going to go for a 6-figure trade. I'm going to go for $250,000. That's my game right now, okay? And, you know, and I just kind of, that's my sort of trajectory from trading 100% freaking long calls and long puts to now being 80% short and 20% long, okay? So, guys, you have a link here for the master course. What's going to go down in the master course, by the way, is you're going to get a whole section on shorting options, basically just everything from the ground up, entries and exits on those as well. And then not only that, remember, the writing options is going to take for one class or maybe 2 classes. The rest of it is understanding the tricks of the trade on timing and on time decay and all this kind of other stuff, you know, how to make sure that you have enough time for the moves that you're looking for, how to manage risk while you're looking for that. If you guys are going to trade long options, to me, the only way to do it properly is if you know how to read bid and ask. And if you don't know how to read bid and ask, then you're not gonna understand why an option is priced the way it is. Why an option is more right for a sell instead of a freaking long. Okay, most of you guys look at an option and be like, okay, does this strike price look good? Yeah, fuck it, I'll go ahead and buy it. There's a lot more science that you need in order to make that decision. Because again, what did we just say? And you guys all agreed. 80% of the time you take a freaking long option, what happens to you? What happens to you? Okay? You all know it. I know it. The question is how do you manage that risk? Okay? And how much size are you going in when you are going these long options? Okay? Because most of the time, you are going to bust on that entry. All right? Now, you could break even. You can break even, you can only lose a little bit, and then when that move comes around, that's when you're in there with the big size, okay? And again, that's my game. My game is timing. My game is understanding tape. My game is understanding when those big picture moves are going to happen. If they're not, we need to be writers of those options, okay? We need to sell them, and we need to book that premium, just like the rest of these giant market makers who you are fighting against to figure out when these things are actually going to move. Okay, so again, you get all that in the course. My own writing option strategy. I'll even give you trades that I'm making, you know, from the past as well, so you can really see some, you know, places where I screwed up. I started figuring it out, and you can start seeing the evolution of my own options writing strategy. And then, of course, we teach tape. We are tape readers, okay? We teach bid and ask. We teach buyers and sellers and supply and demand, okay? I'm trading, of course, from, you know, some of the big order flow that hits out there. You know, to give you an example on that one, Amazon, we had a $9 million call buyer during this shit, okay? We had a $9 million call buyer during this shit, and the guy is up, double, somewhere close to double. You know, so that flow is very valuable. I think Faye here is asking me a question. You long only when high flow? I mean, not only that, but again, I'm tape reader. You know, so I like to have all these things. You know, all these things correlated. The index is doing what you want to do. You got some flow as well. Tape looks good. Options are fairly priced. Boom, that's where you make your entry kind of thing. Okay, so let's go ahead and take some questions here. Remember, free trade here for you guys. All right, sell some freaking puts on Baidu. Wait for the thing to come back a little bit and sell some puts on Baidu. You will make, I don't know, you'll make a couple $100 or $300, whatever the hell it is. But then you'll start to feel what I am talking about. Okay, this is your homework here. We're all going to look at the Baidu chain and sell some fucking puts. Okay, Ruth here is saying, would you sell some puts on Baba? Of course, that is a great question. Okay, of course, the Baba is doing the same thing. We're at all-time highs again. So the only thing that you're making sure you have is that the market continues to hold or push higher, and you still get some juice here going to tech news. Okay, remember, for entries on sell puts, you ideally want to do them on some pullbacks. You know, ideally you want to do them on some pullbacks. All right, because that way you get a little bit of a better entry and you can stomach some of the volatility a little bit better. Okay, but again, that's kind of an advanced concept. We'll talk about that during the class when I see you guys. I believe the class starts Tuesday, October 24th. So you guys do have some time here. We run classes from Monday to Wednesday for 2 hours or 3 hours a night. Obviously, you get the Q&A. You guys can see me. You guys can ask me whatever the hell you want to. There's some additions to the course as well. We also split up the payments too. Okay, so you can split up 50% of it, pay 1 month, and then try to finish the next month. And anybody who is interested in some of the promos that we have, just go ahead and type it in the chat. We will go ahead and contact you through email. Let's go ahead and take some questions. Let's go ahead and take some questions here. Okay, so Eric Johnson is saying, when you put on a stop loss, are you using a limit or a market order? That is a great question. Okay, now let me explain here. So if you're trading a Baidu, guess what's going to happen? Your spread is kind of wide over here. It is kind of wide. So if you use a limit order, let's say, you may not get that limit order filled, and it'll just blow through your stop price, and you'll never get filled. Now that's a problem, okay? That is a problem, all right? Most of the time, though, with these options, even if you use a limit order at, let's say, 100% stop or whatever it is, you'll get filled eventually because these options go freaking nowhere. However, you don't want to get caught in some dumb shit where your order doesn't fill and the stock blows, or the option blows through that price, and you never get that shit back. So most of the time, I'll go market, or I've added a little bit more logic to my stop. So what it means is that it's a limit order, but it automatically adjusts with the bid and ask. Okay, so that way I don't get screwed. I don't get the screw price on a market order, but it's still a limit order that's aggressively going after an offer to get out. All right, for anybody that doesn't understand that, again, these are all sort of the advanced concepts here when you've been trading for a good amount of time. Eric, here, does that answer your question? That answer your question. Stephen here is saying, are you making more? Hold on. Well, let's see. Are you making more or less money overall per year or month with this strategy, or when you were 90% long options? Okay. Also, how much smoother is your equity curve with this strategy than when you were? It is much smoother. It is much more consistent. And Stephen, this is a great question, though. Okay, when I was 90% long options, remember, it's not enough to ask this particular question because there's a lot of different mentality involved, right? When I was 90% long options, all I was concerned with was that, I would try to make $1 million on a big move, right? So let's take this Goldman Sachs, right? I would sit there and watch Goldman Sachs, and then when this move happened, I'd be literally all in, you know what I mean? Or 50% of my account, or whatever the hell it is, right? I was bullheaded. I was going after it like this. So my gains were more, Stephen, technically, but I was in another mind state, right? I was going after this kind of move, right? Now I'm in a different mind state, Stephen. I would rather just collect my $5,000, $10,000 every couple of weeks and just chill, and then when this move does happen, go for a little bit of a, go for a little bit of a lotto, right? So my expectations are a lot lower, Stephen, if that answers your question, right? I'm not out there trying to make a freaking $1 million on a Goldman. Will that thing come back for me? Maybe it will, maybe it won't. So it really depends on what you're looking for, Stephen. Again, I'm just offering this out there as a way to smooth out that particular equity curve. Because when I was long options, and that's the second part of your question, Stephen, when I was 90% long options, you want to know how fucking crazy my equity curve was? I mean, granted, I never even looked at my damn equity curve, but shit, I felt it every single day. I mean, dude, I was up $1 million one month, and then I'd be down 700 the next month, and then I'd be up 2 million the next month. And the shit was insane, Stephen, because again, I'm going directional with size on options. You know what I'm saying? So it really depends, Stephen, on what you're trying to accomplish out there, okay? So yes, absolutely, with this strategy, you smooth out your equity curve, and then is my P&L more or less? Right now it is less, but that's only because I'm not that crazy ass cowboy. You know what I'm saying, Stephen? Does that answer your question? It looks like we got a bunch of questions here. Tomer is saying, what is your strategy following all the MU sweeps? You shorted MU puts, and right now at all-time highs, they're down big on new 1 billion. This is a great question. Okay, so this is one of the largest risks, okay, of being short options, okay? What do you do on the overnight, okay? What happens on the overnight when you're short, let's say, options, or you're short, whatever the hell it is, and you get a monster gap, okay? This is why it's very important to stay far out of the money. So even though you get these gaps, if you're far enough out of the money, you can still manage that position, and most often they'll still expire worthless, okay? But this is a great question. What do you do if you're stopped? Because chances are, if you're short a put here, you're going to open up tomorrow down more than 100% on your options, okay? So number one, you're going to have the spread already to cover your risk, okay? But you got to get pretty aggressive, when it comes to an exit. So you know what I do? And again, you guys can take this. And by the way, this is another freebie here. Another thing that I use in my own strategy here. Homer, what I do is close one leg, exactly. So Alex here has already taken my class, and I'll close one leg. So I'll close the short leg, and then keep the long one open. Okay. So Oliver, does that, who asked that question? Homer, does that answer your question? So I'll dump the short option, get that loss, and I'll keep the long option. And if this thing continues to go down, I'll make the money back on the long option. You know what I'm saying? And your other choice that you could make, to Tomer's question, is trade stock after hours. You know what I'm saying? You also have to know that, hey, shit's got earnings or shit's moving or whatever the hell it is, and then you can start, hedging, with the stock after hours. That's the ideal thing to do. Okay, you should be hedging with the stock after hours. That way, you're going to own the shares too at a certain price, or short the shares or whatever the hell it is, and then your options are just going to close out around it. So that's basically what you're going to do. Again, that sort of advanced concept here we'll talk in detail during the class here. So we got another question here. Let's take one or two more. Oliver is saying, so basically, regardless if you make less writing versus buying, at least you're in the market to feel out price action and sentiment. And if you feel big, size accumulating, then switch to buying options. So Oliver here basically just gave you my whole strategy here. So fuck it, you don't even have to. That's it. You know, right? You don't have to do much else. So that's the whole reason, I'll do this, because most of the time, you take a name like an Amazon or a Tesla, or whatever the hell it is. Like most of the time, this is the price action you're looking at. Up, down, whatever, right? So that's where, this is where the value to me is for the options, right? So you're just going to come in here and you're just going to take a look at both sides of this trade, and for some reason this thing is not going up. But basically, you're just going to look at where the stock has been trading, where it's sort of coming from. You'll take a look at the indexes, you'll take a look at some of the other tech names, and then you'll assess to yourself, like, okay, do I feel this is going to, just sit around for a while? And then you'll go way out of the money here and sell both sides of the trade. And if it starts to feel weak or it starts to feel bullish, things start to change a little bit, you're going to start moving your position. Okay, but essentially all you're doing is scraping up easy ass premium So that is way out of there, all right? That is going to expire in 3 or 4 days or 5 days or maybe even a couple of weeks, whatever the hell it is, and you're just scraping nickels and dimes out here, all right? That's it. That's all you're doing, okay? Difficult thing to switch from a long options only trader to a short because you guys want that action. You want that action, and if you're going to just risk or you're going to use your portfolio to only make $500 or $1,000, you know, you're not going to be too happy about it. But what's the alternative? You want to struggle and try to friggin' get a Goldman Sachs for 6 months? Not that many people have that kind of discipline. So this is just another strategy here that you can sort of add to your toolbox. You know, and maybe it'll help you out. All right, so let's see. Any other questions here? We got one other question. Let's take one more here. Let's go for, I think it's Damien or Damjan. Do you always make spreads with a few days of expiration? What would change in your strategy if you would make spread with expiration 3 months? Yeah, I am a swing trader. Okay. Again, like, I'm giving away too much shit right now. I'm not pissed about it because I really don't give a shit. However, okay, if you're good enough, all right, you're going to get good enough that the real money, and when you get to the point where you have a sizable book and you really want to massage and juice a fucking trade to the max, well, you're going to write farther out, all right? And then again, this damn for some reason this internet in LA freaking sucks too. I don't know what it is. All right, let's just see if we can get Goldman back. Let's get Goldman. Come on. Oh. Okay, so we're going to go Bank of America because we can't get Goldman for some reason, all right? So listen, let's say, all right, and again, I'm only throwing this out there for this is not for the weak-minded, all right? Most of you guys here, you can't be doing this shit, all right? Now, for those guys who have really, you know, been in the game for a while, you got some experience, and you want to add some freaking income to your shit, you know, a name like a Goldman or a Bank of America, I'm that confident now that Bank of America is going to go to $28, right? So the idea there would be to come in here and write something at the money or even in the freaking money, okay? And when you're right on this and you're loading the boat, long calls and short options everywhere, this is where you can really, really make some freaking premium. You know, because a name like a Goldman Sachs, let's take a 240 call, 240 put, let's say, that's 3 months out. You know how much that shit's going to be worth? $5. You know, so not only are you long the calls and short shit around it, you know, you're going to be short, you know, 3 months out, and you're going to get $5 in premium for it. That's basically the, you know, all the premium that you're going to get for the long calls too. So you can add a lot of value here, you know. Tom Jen, does that make sense? Does that make sense here to everybody? And again, if it's, you know, it's a little bit over your head, don't worry about it. You know, this is all stuff that we talk about in detail. But that's another freaking freebie for you, Tom Jen. I wouldn't go fucking crazy though. Okay? And by the way, this is why you do need it, because guess what? You ain't gonna catch this Goldman move unless you know how to read the tape. Okay? Unless you know how to understand timing, how to understand options pricing. You ain't going to catch this move. All right? And I'll give you another thing. Most of you don't have the mental fortitude to sit there for 6 months, take losses, take losses, take losses, and finally catch the move. You know what happens to most of you guys? You take losses, take losses, take losses. Here, you get so pissed off. You probably lose the most here. Okay? And you might even flip short down here. Everybody gets faked out. And guess what? You ain't even in the trade. You're not even in the trade, all right? Can I get an amen? Most of you guys are stuck there. So you need tape. You need to understand how the market works. This is why you need me anyway, all right? However, you got some freebies here to work on for the next couple of weeks. I highly suggest you guys fucking work on it, all right? All right, guys. Let's kill it for there. Remember, sanglucci.com/MC. We can work you guys as far as pricing, and you will be on the phone too with my guy Charlie, and he'll walk you through all the particulars. Any questions that you have on the class contents, the structure of it whatsoever. I know he's got some promos and stuff as well. So again, if you guys are interested, just go ahead and ping on the chat. Just say yes, no, whatever, or I'm interested. Charlie will go ahead and reach out to you through the email. All right, so again, you got your homework. Start messing around with those Biden puts. Just sell a couple of them, and trust me, you'll see what I'm saying, and then the wheels will start turning for you. All right? All right, guys, take care. We'll see you next time.